Hello, welcome to our 2019 Outlook Overview. After a turbulent end to 2018, we wanted to share our thoughts for the year ahead. The recent stock market sell-off resulted in the worst December performance since 1931, and it's understandable how such a dramatic decline can deliver a blow to investor confidence and lead to reactions driven by fear and an instinct to protect ourselves from further losses. Although it can be hard to completely take our emotions out of our investment decisions, it's during times like these that we need to force ourselves to focus on the facts instead of how we feel. That means considering not only our current investment environment, but also the historical investment tenets that we rely on. Avoiding the urge to sell near the market bottoms, sticking to an investment plan, and maintaining a long-term perspective. For the year ahead, 2019, we do expect our U.S. economy to continue to grow, albeit at a slower rate than last year. For stocks, we expect returns possibly in the range of 10% or greater. This is based on the fundamental increase in corporate profits. Currently, the consensus estimate is 6 to 7% greater than last year. For bonds, again, we expect flat returns, albeit that might be an improvement over last year's slight negative returns, flat nonetheless. Trade will likely to continue to make headlines in 2019. Though tensions with China remain, progress has been made with South Korea, Japan, Mexico, Europe, and Canada. Data just this week shows China's exports fell 4.4% over last year. This marked slowdown likely puts additional pressure on China to strike a deal. Even though we expect a resolution, if it takes longer than expected to reach an agreement, then it's possible that continued trade discussions could further weigh on market sentiment. The ongoing uncertainty could have a greater impact, potentially slowing the pace of business spending or the rate at which fiscal stimulus will take effect. However, despite all the attention given to tariffs, world trade's actually been growing at a steady pace. So far, the market has shrugged off the current government shutdown, which is now the longest in history. And while we believe we can get to a resolution without much harm to the overall market or economy, we'll be closely watching the political developments as we enter the summer, as there will most likely be even more contentious debates over raising the nation's debt ceiling. But historically, a Republican president with a split Congress has been positive for both the economy and stocks. I mentioned that we expect both the US and global economies to continue to grow this year. It's important to point out that there is the possibility that a self-fulfilling recession may develop. In other words, as political and trade uncertainty leads to falling asset prices and limits business investment, this could pressure growth and productivity, unemployment, and consumption, thus slowing down the overall economy. However, given the record levels of US GDP and employment, stable inflation, as well as positive manufacturing and service reports that are still indicating expansion, it does still look like a recession is unlikely in the year ahead. Investors' obsession with the flattening of the US Treasury yield curve dominated headlines for much of 2018. A flattening yield curve occurs when short-term rates are rising faster than long-term rates, which may eventually lead to an inverted yield curve where short-term rates are actually higher than long-term rates. Historically, that's been a negative signal for the US economy, often providing an early warning of an eventual recession, which this is why this has been garnering so much attention recently. We believe these concerns are overstated, given the positive economic environment we're in. We do expect both short-term and long-term rates to gradually rise in 2019, keeping that yield curve somewhat flat. However, if this continues to occur in the context of solid economic growth and modest inflation, we don't think a flat yield curve should read as a signal of a rising recession risk. There is and still will be debate as to whether we are still in a bull market. The technical definition of a 20% decline came awfully close on Christmas Eve at negative 19.8%, although on an intraday basis, the line was crossed. Regardless, the recent bull market is officially the longest in history, and the economic expansion is quickly approaching that milestone as well. It'll be the longest expansion ever if we make it to May of this year. So what does age have to do with it? Considering that on average, the typical bull market and expansion lasts approximately 5 years, reaching the 10-year mark is quite a feat. But for those of you who are concerned that the cycle has gone too long, there's some interesting context to consider. Assuming the start of the current expansion began after the lows achieved in March of 2009, then it is the longest, or will be the longest in duration, but not in magnitude. Meaning the total GDP growth achieved in this expansion period has been significantly lower than many prior expansion periods. For example, the total growth of the economy since March of 2009 has been 24%. Compare that to the expansion in the 90s, where the size of our economy grew by over 42%. It's almost double. Substantially rising corporate earnings without subsequent increases in stock prices last year caused price to earning valuations to fall. You may have heard me refer to this as lowering the market's cholesterol, suggesting that stock prices are healthier than at the start of 2018. Typically, large drops in PE have been followed by strong market performance. We do feel developed international markets will underperform in the coming year. Growth in Europe has been slowing and may struggle to even reach 2% in 2019, while growth in Japan is also lagging, despite stimulus and corporate reform efforts. Add to that a significant amount of political uncertainty in Europe with Brexit, and now Italy. We favor emerging markets over developed international for their solid economic growth trajectory, favorable demographics, attractive valuations, and even prospects for a U.S. trade agreement with China. GDP growth in emerging markets is likely to be more than double the pace of developed international economies in the coming year. As always, if you have questions, please don't hesitate to reach out. Again, thank you for listening and have a happy new year.